Now we're finally going to talk about the cash flow statement, which is the most important one probably, and the hardest one, because you can confound it very easily with income statement or balance sheet. It shows the movement in cash account of a company. It presents cash inflows and cash outflows. So imagine you have this company. Here we talk only about cash. Remember, this word is very important, the movement regarding cash and cash equivalents. Cash can go in a company or out of the company. So, the income statement is prepared under the accrual basis of accounting. This means the revenue and expenses reported may have not been collected, whereas the cash flow statement has already integrated that part. That is why many investors prefer the cash flow statement. It starts with the net income. It shows how changes in balance sheet, accounts, and income affect cash and cash equivalents, and breaks the analysis down to operating, investing, and financing activities. Operating activities converts the items reported on the income statement from the accrual basis of accounting to cash. Investing activities. These include any incoming or outgoing cash from a company's long-term investments and property, plant, and equipment. Financing activities. Cash from financing activities include the sources of cash from investors or banks, as well as the use of cash paid to shareholders. Not only important to know the meaning of cash flow statement, but also the difference between it and balance sheet. A balance sheet shows the assets, liabilities, and equity of the business at a particular point of time, whereas a cash flow statement shows how movement in assets, liabilities, income, and expenses affect the cash position. A company that has a strong balance sheet can endure tough economic cycles. The cash flow statement tells the investor why cash is behaving the way it is, unlike the profit and loss, which can be misleading and can be easily manipulated. That is why I also prefer the cash flow statement. Another reason for that is that the cash flow statement is prepared on the basis of the balance sheet. But the balance sheet is not prepared on the basis of cash flow statement. But it's not over. We are trying to understand and answer all the questions here. What is the connection between operating income and net income? The cash from operating activities is compared to the company's net income. If the cash from operating activities is consistently greater than net income, the company's net income or earnings are said to be of a high quality. If the cash from operating activities is less than net income, a red flag is raised as to why the reported net income is not turning into cash. So you need to have positive operating activities here. A cash flow statement identifies the cash that is flowing in and out of a company. If a company is consistently generating more cash than it is using, the company will be able to increase dividends, buy back some of its stock, reduce debt, or acquire another company. We talked about this. All of these are perceived to be good for stockholder value. We can also use the cash flow statement for some financial models. One of these is the discounted cash flow, and we'll talk about this in the next video. Very important because I use this, a good model to keep in mind. I like it, I learned it thanks to Warren Buffett, so be prepared for the next video, guys.